Hello everyone, welcome back to the Sarah and Suzanne YouTube channel. Today we are talking about one of our favorite subjects, and that is seller carried financing. We are not lenders, we are licensed real estate agents, so take everything we say with a grain of salt. Always consult your attorneys, CPAs, all those things. But we're going to get into a little bit more detail on what seller carried transactions are, how they work, and the differences between using a promissory note with a deed of trust versus a contract of sale with a memorandum of contract, because these are important differences that you should know about. Seller carried transactions are one of our favorite topics because they can create so many win-win opportunities when people actually embrace it and know what they're doing. It can save buyers tons of money and make sellers money that they didn't know they could when being the bank. So basically, instead of going through a conventional lending process, going to pay a lender or a broker directly, the seller gets to act as the lender. And that kind of flexibility opens all kinds of doors for buyers that don't fit in the traditional financing box. And all of us know that when we're real estate investors, we typically don't fit in some kind of box, right? We are usually doing things outside the norm in some kind of gray zone. So seller carry financing carries all kinds of perks, benefits, weight, and also gives sellers steady income and oftentimes better returns than they would have gotten just by selling their property conventionally to a conventional buyer. So what we should know is, however, like everything in real estate, it's all about the contracts and the paperwork, and the documents you use matter a lot. So let's break down the two main ways that these kinds of deals are structured. First up is our promissory note and deed of trust, and this tends to be the most common box that's checked on these forms. So we should talk about it. We want to talk about the promissory note and what it really means. And I like to explain it as thinking of it as the I promise to pay you document, okay? It lays out all the very specific loan terms, how much is being borrowed, the interest rate, how the payments work, and what happens if the borrower doesn't pay. It's a legally binding commitment. So this is something that is prepared, or I should say, terms are negotiated in our contracts, and then this is something that can be prepared specifically by escrow, just based on what's outlined in your contracts, or you can bring this to an attorney and have it be an attorney prepared document as well. But this is really just all the nitty gritty, and you can really get as creative as you want with this document and put whatever you want in it, because this document is really just for the buyer and the seller together. It doesn't get recorded anywhere else. This is just a legally binding contract between the two parties exchanging property. So you have this promissory note, and then you have the deed of trust. And the deed of trust is actually what secures the loan to the property. And this part involves actually three parties. So it involves the borrower, who's the buyer. It involves the trustee, which is a neutral third party that holds the title. And then the beneficiary, and that's the seller acting as a lender. So in this case, if the borrower defaults, the deed of trust allows the seller to foreclose through the trustee. So the key here is this setup gives the seller a secured interest in the property. And it's typically, this is typically the route we go if we're representing the buyers, because what happens here is the name on the deed still gets transferred at closing, but this deed of trust essentially acts as a lien for the seller on their own property until that note is satisfied in full. The other approach and the other box that we can check on our seller carry contract documents is using a contract of sale, and it usually is accompanied with a memorandum of contract. So a contract of sale is basically just the purchase agreement, right? It says, here's the price, here's the down payment, here are the terms, and it's a binding agreement. It's a binding agreement between the buyer and the seller. Now, the memorandum of contract is what gets recorded in public records. And that's like putting the world on notice, right? Hey, there's an agreement on this property. It protects the buyer by making the deal visible, but it doesn't transfer title or create a lien. So we like using these situations where we're representing the seller because the seller tends to have more protections when these contracts are used because, like we just said, the deed never changes from the name of the seller, and essentially in this case the buyer ends up basically having a lien on their own property, making sure that the seller can't sell it without having satisfied their contract of sale terms first. Okay. And another case in which we use this approach is when there's an existing mortgage on the property. If we're doing some sort of wrap agreement or assumption of loan, because once again, there's no transfer of deeds. So this format is less likely to trigger a due on sale clause. So let's talk about the key differences now. With a promissory note and deed of trust, the loan is secured by the property and the seller can foreclose if the buyer doesn't pay. But with a contract of sale and a memorandum of contract, it's a more notice-based setup. So the seller doesn't really have the same foreclosure remedy because there's no lien tied to the property, but the deed never left their name anyways, right? So which one's better? It really depends on your situation and your representation and what both parties are trying to accomplish. Really, they're both commonly used, they're both super secure in their own ways, but in most cases, the note and deed of trust structure tends to be the strongest because it ties the loan to the property, but it does, you are formally changing the deed into another name. So if there's a existing lien on the property, probably want to avoid this. So again, some better protections for the seller in this one because you can foreclose on the property, but again, depends on your situation. Contract of sale can work too, but again, it's a little bit less protection on the security side because it's more about documenting the deal and giving public notice. Bottom line, seller carry financing is an amazing tool. There's so much value in it in our market here in 2025 when interest rates are pretty high. Historically, when conventional interest rates were lower, when we were negotiating seller carry finance deals, interest rates tended to be higher than conventional rates because they do provide so much cost savings to a buyer up front. But now we're negotiating interest rates that tend to be lower than market standard because it's really hard to make deals pencil in, rental deals pencil in this interest rate climate. So it's providing another lever to pull in our deal analysis and just our ability to exchange properties and make it meet everyone's goals. So if a seller, for example, is selling a property for the same purchase price that they're asking or even slightly lower, we can do the math for them and show them, hey, over the term of the seller carry financing loan, look, like you're collecting $200,000, $300,000, $500,000 in interest income that you wouldn't have otherwise been collecting to add to, the purchase price that you'll be cashed out on later. So oftentimes this actually works out better for sellers in that case, and also offers sellers the opportunity to defer capital gains tax too, right? If they don't plan on doing a 1031 exchange with their investment property. So as we've outlined here, we know that this strategy is not one size fits all, and really just knowing the key differences between these legal instruments helps you choose the structure that fits your goals better. Of course, as always, like we said, we are not real estate attorneys or certified accountants in any way. So make sure that you are bringing your whole investment team in on these strategies when the time comes. And yeah, I hope you found this helpful. I think these differences are really interesting and of course really important for what we do. And I hope you thought so too. So give us a like on this video if you agree. Also make sure that you're subscribed to our channel. And let's do more deep dives into creative financing in the future. And if you're searching in the Central Oregon market or anywhere for an investment here, reach out to us because we probably know somebody that can help or can help ourselves. See you on the next video.